Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here's your weekly technical analysis of Kansas City and Minneapolis wheat markets. Kansas City wheat. There is a lot going on here within a fairly narrow piece of action. Not in market price movement as such, but in a narrow piece of market angle of attack. To explain, 5 weeks ago I looked at the action since August and saw a possible descending expanding wedge pattern, currently 552 to 661, which is highlighted in dark blue on my daily chart. This is not the best example of such a pattern, but as I said 3 weeks ago, and I quote, it does hold merit and I would look to this pattern for some immediate idea of the move downwards, end of quote. Well, it does hold merit, and I have also seen the development of two new patterns, one of which involves the descending expanding wedge pattern. So if we utilize the lower trend line currently at 552, highlighted in dark blue, of the descending wedge pattern, and then use the next upper trend line, which you can see as the higher of the two dark green trend lines, currently at 609, we have a bear channel placed within the original descending expanding wedge pattern. Then again, if we look purely at the upper and lower dark green trend lines, currently at 591 to 609, we have a descending wedge pattern, once again placed within the original descending expanding wedge pattern. I hope I have ably explained what my thoughts are, and also the three main patterns that are driving this market. Please feel free to replay this part. Now, 2 weeks ago we had an attempted break lower out of the green descending triangle, but which failed, and failed somewhat spectacularly with a weekly key reversal up that punched up right through the descending wedge pattern, closing above it and just over the January 2015 high at 546. Last week we saw various attempts higher, along with a consolidation on the January 2015 high and penetration of the declining short medium moving average, currently at 656, which has been wrapped around the upper trend line, as well as testing of the upper trend line of the descending wedge pattern. Last week this move higher raised some potentials topside and a question. The potentials are for the descending wedge pattern with a primary target X in the 721 area and a secondary harder to reach target X1 in the 775 area. The question it raised was whether the move higher stimulated the action since mid-August into being a descending scallop pattern or not. The answer to this question is still unobtainable as yet, but I'll be watching closely to see if the market's actions fit that bill. I added last week, and I quote, all this is of course dependent on what and how far the market will rise, end of quote. Well, this week prices have pulled back lower to the January 2015 high and just below it, but not as far as the green coloured upper trend line of the descending wedge pattern. Thus we are now outside the descending wedge pattern in green, but still within the bear channel in dark blue. For the moment, I will still maintain the potentials topside, but I will also look at some of the obstacles in the way topside. Thus we have the 50% Fibonacci line of the big 2011-2019 move at 691 and the 50% absolute Fibonacci line at 697. However, their support on the way down was limited, so I am unsure how good a resistance they may become on any move higher. It may be left up to the declining medium moving average, currently at 699, and the December 2014 high at 707 perhaps, to show some resistance in any rise. But if prices continue rising as far as the June 2014 high and the 2022 low combination at 748, well, then the idea of a descending scallop pattern will need to be reappraised. But a lot depends or needs to happen first before we start seriously thinking about that far up. Minneapolis wheat. Compared to both Chicago wheat and Kansas City wheat, Minneapolis wheat had been somewhat easier to read in the past with respect to what was going on and what the opportunities might be. This is no longer necessarily true, but it still has its moments. In late February, and especially at the start of April, so that is just outside the parameters of my daily chart, the market constructed a large bear channel that morphed into what we now see highlighted in dark blue on my daily chart. A descending expanding wedge pattern, currently 796 down to well off the bottom of my daily chart. This actually originated from December last year, but only really became evident from February this year. The upper trend line had been escorted and reinforced in the past, well, sort of, by the declining medium moving average, currently 767, which, when combined together, helped cap the market back in very early April, then mid-April, mid-May, and mid to late June. However, mid-July, the attempts higher resulted in a clear break above the upper trend line, and also the important declining long moving average, currently at 807. Prices climbed rapidly up to the 50% Fibonacci line of the significant August 2020 to May 2022 move at 955, where the rally petered out and turned back down. It is this turn back down that's captured my attention, as the market had, since late July till mid-September, formed a descending scallop pattern. Not only that, but since mid-September, the market formed the crucial ski jump, of the ski jump of this descending scallop pattern, and from the start of October it started on its subsequent journey lower. The potential targets below for such a pattern were a primary target in the 708 zone, with a secondary hard to reach target X1 down in the 689 zone. 2 weeks ago, the market punched down through the recent 737 to 724 congestion zone down into the next congestion zone below between 693 to 708, thus reaching the primary target, but finding itself overextended and reverted back up. The move higher stalled last week at the overhead declining short medium moving average, currently 737, which is highlighted in green on my daily chart. This moving average has been an effective cap on the market since mid-October, not tested but effective nonetheless. The test last week led to a daily key reversal down and bearish Harami combination, which eventually this week followed through lower. The move lower exited the recent 737-724 congestion area and dropped down to test the lower 693 to 708 congestion zone again, not venturing as far lower as it did 2 weeks ago, and has shown intraday indecision to the 4th degree as it ping-ponged in between the overhead congestion and the support below. So the question of whether to move lower is still being debated, as is any move higher. I'd now like to highlight a more recent pattern, one I spotted 6 weeks ago. It's a nascent late August to date bear channel, one I spotted, a bright red on my daily chart it actually is, currently is 661 to 758. This pattern is still operational, and I once again note how we have here also a small bear pattern nestled within a larger one, much like a Russian doll. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.